Now, so thank you to everyone for joining us this afternoon for the first of 4 Meet the Fund Manager events taking place this year. And to start the series, I'm delighted to welcome Jim Henderson to speak to us today. Joining us today from Los Angeles, where it is 4:30 a.m. in the morning. So thank you very much, Jim. We'll get to that in a moment. Aristotle Capital Management have managed the North American fund for St. James's Place clients for over a decade. Jim is here to talk about the fund, the market, and anything else that comes up during this Q&A. And I'm sure that there will be some questions on some topical events this year as well. The structure of today's event will be as interactive as I could possibly make it. And although I have had questions submitted by attendees in advance, please put your questions in the Q&A box as we go as well. That you can find that at the bottom of your screen. My aim here is to get through as many questions as we possibly can, as many market themes as we can, but this session's shaped around what you, the audience, want to be discussed. So I will put as many to Jim on your behalf as I can. To start the conversation off, Jim, and to give people a chance to submit some questions, I'll start with a nice and easy one. Can you introduce yourself, your strategy, and how you manage money at Aristotle?
Yes. Thank you. So I'm Jim Henderson. I've been involved with this partnership between Aristotle and SJP since its inception, and it actually goes back many, many years. I've been a client portfolio manager for Aristotle since the inception. The fund that we manage is the North American Equity Fund, in that we're investing in companies that are exclusively found in North America with a particular strategy, with a particular philosophy. And that is that we endeavor to uncover businesses that we believe have a competitive advantage, that there is something special with these companies that we believe will cause the businesses to exceed what their competitive landscape is, and do it in a manner that is consistent over a long period of time, because we're buying these companies when we can find them at a substantial discount to what our appraisal of their business value is. So we're looking for very high quality businesses that are selling at a substantial discount to what our appraisal of the business value is. And then lastly, we're looking for what I call differentiated thought, something that's different, that we understand to be different, that is not well appreciated in the marketplace. If the answer to that question is nothing, then we've got a great business that's probably undervalued and there's no reason to buy it. But if we can uncover something that is special, unique in our thinking in that business, then that gives us that three-legged stool of comfort that we think we've got a great business that can do well, and we'd like to hold on to for a long period of time. Our average holding period is 3, 5, 7. There are some companies that have been in the portfolio for a decade or more.
And I've spoken to you several times in the last decade. We were just saying that I think this is the third election. We'll get to politics, but this is the third election where I've interviewed you ahead of it. I've obviously spoken to you several times in that decade, but outside that as well. And you've always said to me how different to everything else that post 2020 was. As we speak now in May 2024, how do things feel right now?
Better. I think that, look, 2020 COVID was a game changer, right? And it was global, and it affected just about every business. It affected just about every economy. We're still feeling some of the ramifications of that, because if you think back to 2020, when we had the economic lockdowns and individuals were staying home, that changed a lot of technological advancements, a lot of technological needs. But from an economic standpoint, what it did was, we spent so much time at home, and those that were able to, continue their employment saw their savings rates go way up. So the savings rates in the US just exploded over that period of time, because we had nothing to spend our money on. We couldn't go out, we couldn't travel, we couldn't do anything. So we had this huge savings rate bubble that now has been worked down over the past couple of years, and has kept the economies in the States and other places, continuing to do very well. And then if you add on top of that, we're in the States running a $2 trillion a year budget deficit, that's kind of priming the pumps, which is completely unsustainable, and everybody knows that, fueling the inflation that we have seen. That's starting to work itself down. So we're still feeling a lot of the ramifications of pre and post COVID today, but it's getting better.
So I was going to, so we had a rough outline of what we were going to talk about, and I'm already getting politics questions, so I'm going to jump straight to it.
Sure.
There's no point waiting, because otherwise we're just going to get more and more. So look, I know you don't like to veer into politics. I find it's an absolute no in these things, but I do remember interviewing you in the lead up to the 2020 election, and you saying that the US political system is not set up to get anything done, which I thought was a great phrase, and a quote that stuck with me ever since. Is there anything different about the 2024 election here, as we sit here in May, that might affect your thinking going forward?
No, not from the standpoint of um, the way that the U.S. system is set up and designed to make it very difficult to get anything done. And the reason I said that is, if you look at the three branches of government, the legislative, the executive, and the judicial. If you look at the legislative branch, you've got two houses of Congress. One, you need a supermajority to get anything done. One, the House, which is, more volatile, and because of the way we've set up our system in gerrymandering, you have, it tends to invite extremism in that standpoint, because you have safe seats that you really are not competitive, and so it becomes a little bit acrimonious because of that. And then, as I said, in the Senate, you need a supermajority to get anything done. And so, I mean, if you look at today, the issues that we're faced with the border, everybody agrees something needs to get done from that standpoint, but it doesn't get done. And that's the reason why. So what do we see in 2024? I mean, it's not, Darren, it's not like I don't enjoy talking about politics. I do. I'm kind of a political junkie, and it's fun to talk about. But from the standpoint of how it's going to affect markets, how it's going to affect individual businesses, it really doesn't, because the ramifications of policy that gets enacted in any Congress is generally not felt for years, if not decades, subsequent to those policy enactments. So things don't particularly change very quickly. And if you look at history and use that as a guide, you see there's very little evidence that one party versus another party is better for the economy or better for the market. There's just really no evidence to suggest that that's the case. In 2024, I will say this though: if we think back to 1776, when this country was founded, we had a little less than 2 million population. Okay, a little less than 3 million. Sorry. And of that 3 million population, we have the likes of Washington and Adams and Jefferson and Franklin, Madison, Hamilton, some pretty impressive people. Today, we have a population a little bit in excess of 330 million people, and we have Biden and Trump. So something's gone horribly wrong.
Is that the quote at the end? That's fine. No, look, I want to get onto the companies that are held within the funds, and I will get to that point. And politics may play a part within some of the answers to those questions as well. But I think what we're trying to stress to people is that, investing in the wider market, investing in large, in many cases, global multinational companies, one election doesn't tend to derail these things. If you're investing for a long period of time, you're going to see a number of elections, et cetera, et cetera. So we're not necessarily running funds here, and certainly Jim isn't running funds here, which are going to overreact to single pieces of news and things like that. Now, if anything fundamentally changes, absolutely, anyone reserves the right to move funds, and that's the whole point of active management. But as we sit here now, there's a lot of time and a lot of water to go under the bridge until November, and there'll be a lot more that St James's Place will release to you and your partners along the way, many of which are already being planned. So, Jim, let's get to other things that have been moving the market and taking up a lot of column inches and and websites and things like that. The market seemed to spend a lot of 2022 ignoring what the Federal Reserve told them, and then 2023 reacting to every single comment from the Federal Reserve. But in 2024, certainly looking at the first 4 months, it feels and looks like we're reaching the point now where earnings growth matters again, which is a very old-fashioned view, but actually maybe more important than predictions about interest rates. Are you getting that feeling that the market is moving on earnings now?
We are.
Rather than speculation.
Yeah, we are, and um, for us, we think that that's a major positive. And if you look back over long period, earnings growth drives the market. I mean, over longer periods of time. And in the short term, the markets are clearing mechanisms, based on supply and demand, and those markets can move very quickly and sometimes very violently. But over the long run, the market is going to be driven by earnings growth and productivity and businesses being innovative, and things like that. And in the short run, you can have disconnects, and we've seen that over the past couple of years, certainly with the concentration that we've seen in the marketplace, over the last 18 months at historic levels. We're starting to see now more market movement on earnings releases, and that's pretty short-term oriented, and we tend to discount that a bit and look more longer term. But to start to see those market movements based on earnings releases and not what the Federal Reserve is saying, whether there's going to be 1 or 2 interest rate reductions between now and the end of the year, we think is a major positive for a strategy like ours.
So along with the political questions that came in very quickly, so too have the technology sector questions. So let's delve into that. We'll get on to what's in the fund and what isn't in the fund, so in a moment. But we talk a lot about the market, in this case, the US market, not necessarily being the economy. And I think when we say that, none more so than in the US. How much of a potential issue is it for the wider economy and the market that the current concentration of technology stocks make up, where more than a quarter of the market could be 6 companies, for example? How much of an issue is that for investors, for the economy, for you, or is it overblown?
It's both. It's an issue. I mean, it's something that one needs to deal with and look at and understand where your risks lie, whether you're owning a business or not owning a business, right? If you're not owning a business that's 7% of the S&P 500, for example, then you're taking a risk and not doing that. So I think one needs to understand what is driving these businesses and why that concentration is what it is. But just to give you some numbers here, if you look at last year, I'll broaden it out to the top 10. I know we talk about the Magnificent Seven that includes Tesla and Apple and others, but the top 10 are now 32% of the S&P 500. Okay, so almost a third are found in the top 10 companies. So that means of the S&P 500, the other 490 companies are making up, the other 2/3. If you look at the returns of those top 10 companies in 2023, the top 10 contributed 96.5% of the total return of the S&P 500. So if you didn't own those top 10 companies in the S&P 500, you didn't participate in that market rally that took place last year. Now, if we look at the share of earnings, because we just talked about earnings being the most important thing over the long run, so the top 10 are 32% of the market cap. They're only 21% of the S&P 500's earnings. So there's a disconnect between earnings and what their valuations are in the marketplace. And that disconnect is pretty wide. If you look at the PE of the top 10 companies in the S&P 500, they're trading at 42 times current earnings. The rest of the market is trading at less than 20 times. So it's masking what the true value of the US market is right now because of those companies. And like I said, if you didn't own those 10 companies, then it was very difficult to compete with the S&P 500. We've obviously competed pretty well against it over the long term. Last year was a little bit of an anomaly because of that. And we're going to talk about what we own and what we don't own.
And in terms of, I feel like I've asked you this several times over the years because these stocks have been in your fund for so long. But can you talk to us about Microsoft, which is obviously part of the Magnificent Seven, if we want to use that? And then you've also got Adobe. So Microsoft and Adobe have been sort of cornerstones of your fund for as long as I've been interviewing you. Two highly successful stocks, recognizable names. Where are these in your current thoughts? And also, amid the constant noise of the technology sector, what stands these two out apart from the others?
They have very high market shares in very stable businesses that we have a call option on their forays into AI. All right, so let's start with the stable businesses. You mentioned Microsoft first. Microsoft's the largest software company in the world, right? They have a very stable global leadership in productivity software. So just to give you a couple of statistics, they have two near monopolies in a couple of their products. Microsoft Windows, they have a 75% market share. In Microsoft Office, they have a 90% market share. Of the Fortune 500 companies, 90% of them use Microsoft Cloud, Azure. And they've got 300 million users in Office 365. They've got 100 million active users in Xbox Live, their gaming system. They have 830 million users of LinkedIn. So here's a very stable business that's been around for quite a long period of time that has generated market shares that are irreparable for other businesses to come in and compete. So we've owned this business for a long period of time. They've initiated their cloud-based philosophy and moving a lot of their software offerings into the cloud. Instead of buying software licenses, you now have a subscription to Office 365. That's been very successful for them. One of the reasons why the stock has done so well, and we've owned it since 2014, so it's been almost 10 years of ownership in it. So I guess it begs the question is, okay, that's happened, but what's going on now? What's changing? Why do you continue to own Microsoft? Well, there's a number of things that Microsoft are doing that are very, very interesting. They've been kind of, a second or third tier search engine with Bing, right? That's changing. They're taking share away from the big behemoth of Google in share because they've integrated AI into the search mechanisms with a business that they're calling Copilot. And that's been very productive. The downloads for Bing have increased significantly. They've got about 140 million active users in that strategy right now, and it's increasing. Now, Google is still the biggest with 1 billion active users. So the market share that they're taking is significant, but they still have a ways to go. And they've initiated several different types of predictive and generative AI technology into their products and selling in others. And they just announced MAI-1 that they're in testing phase on now. That is a generative AI process. It's got over 500 billion parameters when you look at the way that that system works. So they're coming out with a number of very interesting products. And the way that we see it manifesting itself into is this company a good value today is looking at their commercial bookings. And I'll leave you with this. Their revenue gains over the past 12 to 18 months have been in the low teens. Their commercial bookings last quarter were north of 30%. Commercial bookings will manifest itself in revenue over a period of time as those bookings become booked as revenue. So you're seeing commercial bookings more than twice what their revenue growth is.
Somebody's put a question in of asking if you've got a specific strategy around AI. You mentioned AI a couple of times there, and obviously in relation to Microsoft. Is it an area, certainly over the last couple of years, that you found yourself looking at more and more, trying to find opportunities there, or is it just something that is blending in with the rest of the market in your everyday work?
No, it's a very interesting topic because it is such a game changer for a number of businesses. And a lot of the Magnificent Seven, with the exception of Tesla, and even Tesla has some degree of AI built in to those businesses, from NVIDIA and Apple and others. So it's an area that I think one needs to understand how it will affect businesses in general. Some positively and some very negatively. So I think that the economic disruption of AI is something that really needs to be understood. I mean, we were talking earlier about our kids going to university and such. And if I had a child who's going to university and wanted to be a radiologist, for example, reading X-rays and looking at tests and things like that, I would recommend against it. I would say, look, this is an industry that AI can do better than human beings can do. So it would be very difficult. The law is another area where, a first year or second year law student is going to spend their time doing document checks, right? They're not going to need people to do that because AI can do document checks better than a human being, quicker and with a greater degree of accuracy than human beings can do. So I think it's something that really needs to be understood. And the ones that we've invested in Microsoft and Adobe, they have AI offerings that complement their existing products, right? So if you look at Adobe and their Creative Cloud suite of software from Photoshop and others, they're integrating their AI offerings into those to be able to generate images both in still pictures and in video. We saw a demo. They just had their investor day actually in London last month, and they demoed their new generative AI tools that they're adding to Photoshop that you could actually take. I've Darren Johnson on my screen right now. I could take him out and put somebody else in and have them do the exact same mannerisms that you're doing. So these things are very interesting, and we've chosen to invest in that as kind of a call option in the businesses that we think are already very high quality businesses.
So this is the first of 4 fund manager events, and I may not see the third or fourth ones because some AI will probably be hosting it by then. Is that right? Okay. We've got 3 separate. I know this is a company you don't own, but we got 3 separate questions in a row, and I think it's an easy way of getting around this one. Tesla. It's funny you mentioned Tesla. I knew that straight away. There's going to be Tesla questions. It prompts. Any mention of it prompts. Somebody's asked, what are your thoughts on it? Is it a car company? Is it an AI company? Is it an energy storage company? How much time have you spent on it? How much time have you looked on it? Why don't you own it? I mean, you can take that question as you wish.
So we have looked at it extensively, and we needed to understand Tesla because we have some ownership in auto parts manufacturers. And so the supply chain that's feeding its way up to Tesla is very important and changing dramatically because of the electric vehicle market. So we've spent quite a bit of time in understanding the supply chain that Tesla is utilizing. And to answer your question, it's all of the above. I mean, it's a company that is in the forefront of autonomous driving, and obviously in electric vehicles and energy storage. And those things are developing rapidly. So we have spent a lot of time on it. Now, the only reason that we haven't owned it, well, there's a couple of reasons we haven't owned it. We've chosen, and we spent a lot of time in the auto industry. We've chosen to go down the supply chain in our forays into the automobile industry, just because the actual who is going to win the electric vehicle race, who's going to win the internal combustion race, is something that's very hard to predict. But we can predict from the standpoint of, well, they're going to need tires, so we're going to invest in Michelin. And if electric vehicles continue to gain market share, they wear tires out more quickly than does an internal combustion. So we've invested there. Tesla's always seemed to be a bit expensive. So if you go back to what I said to your first question about what our investment philosophy is, the second leg of our stool is is this company trading at a discount of what our appraisal of the business value is? And we've never gotten our arms around that.
If it does feel, between politics and technology sector, we could probably fill 3 hours of this, but I'm conscious
sure.
that we only get so much time, and there is a lot of other things in the fund which I want to cover off. You've got 16% of the fund in financials across a number of stocks, which to some people feel high, some people feel low. Can you discuss some of the larger holdings? And the one I've pointed out is Capital One. Can you talk a bit about that, and particularly how you see the financial sector?
Yeah. Well, it's interesting that we're talking about Capital One, because there's a lot going on with Capital One right now. And if we go back to our original investment thesis for Capital One, and the factors that we identified as catalysts for this business, that hasn't changed. The company's been around for not a long time, 1988. It was founded by a guy by the name of Richard Fairbank. He's still currently the CEO. They're the number 3 issuer of credit cards in the United States, only behind MasterCard and Visa. So they're the number 3 operator in there. And what Capital One has done for the better part of the last decade is continually invest in IT. And their data capabilities and their marketing capabilities. Gosh, we can't turn the television on without seeing a Capital One ad in the States. They've taken quite a leadership role in underwriting, in mitigating losses that are inherent in the credit card business, right? They've also led and been on the forefront of variable pricing when it comes to the credit card market. Depending upon what your risk parameters are, they're charging you differently, and that's not been the case heretofore. So they've been very strong. They've been very strong in private label credit cards. They signed a deal with Walmart a couple of years back, with Williams-Sonoma, with REI. So they're the backbones of those private label credit cards. They've also gotten into auto lending, which has been very big in the States in the past couple of years post-COVID. So, all of those things have been very positive, and the stock's done very well for us. Well, what has changed? Well, they just announced, and this is just last month, no, in late February, that they're going to acquire Discover. So they are going to basically double the size of the business in acquiring Discover. Now, what this does for them is it's going to create a global platform scale with over 70 million merchant acceptance points, operating in over 200 companies. So they're really now going to be a formidable competitor to both Visa and MasterCard. They're able now, and I mentioned this earlier, that they've spent the better part of the last 10 years upgrading their IT systems. They'll be able to roll that out over a much larger platform now. And right away, that acquisition is going to be accretive to the tune of almost $3 billion a year. So, it's not going to close until the end of this year or early next year, but we expect to see the free cash flow that will be generated by this particular company through between now and say 2027, 2028 to be significantly greater than they have in the past. The other thing that I would point out, because you mentioned we have 16% in financials, most of those are in what we would call large regional banks, between Commerce Bankshare and Cullen/Frost. These are companies that have been around since the late 1800s. They've gone through many market cycles, many interest rate cycles. They know their customer base very well. And we tend to invest in companies like them that have very high market shares, high returns on assets in the areas in which they operate in. So Cullen/Frost is in kind of the oil belt of Texas and Colorado and Louisiana, and Commerce Bankshare is in the Midwest. And they all have very, very high market shares and have been doing business in those areas, like I said, since the late 1800s. And they also pay pretty good dividends too, Darren.
Which is always of value to shareholders in terms of total return funds. Absolutely. Another sector which we've had a couple of questions on, and therefore I've just done a quick bit of research to find out how much of it is in the fund. the energy sector, less than 5% of your fund is in energy, but I think I need to ask it anyway. Mainly because that's maybe surprising that it's so low in a period where these companies are making such big profits. What's your view on the energy sector? What are the opportunities there from a US point of view?
Well, the fact that we are underweight in energy now is not an anomaly. We've been underweight in energy companies for a decade. And the reasoning for that goes back to your very first question. Like what is our investment philosophy? What kinds of companies are we trying to uncover? And I started by talking about high quality businesses that have a competitive advantage, right? Businesses that are operating in a commodity area tend to not fit that bill. They tend to do well when the commodity in which they're operating in does well, and vice versa. So their futures are not really of their own doing. Now, there are exceptions to that, and we've owned some in the past, and we will own some in the future, but there's generally something special going on with those businesses that allow us to kind of take that leap of faith that the commodity in which they're dealing in won't be as big a driver for those businesses as maybe most are. Now, over the last year, oil prices are up some 10%. There's been some M&A activity, some very large M&A activity in the integrated oil business, which has caused some companies to do very well. We know that one of the companies that we used to own, Pioneer Natural Resources, is being acquired by ExxonMobil to be now, one of the largest integrated oil companies in the world. Hess was just acquired by Chevron. So there's a lot going on, and we continue to follow it. But the fact that we're underweight right now in energy is not an anomaly, and actually should be expected going forward. Now, with that said, let me just add one other thing.
Okay.
That helped performance a lot in periods like 2005 through 2007 when oil prices were collapsing. It hurt a little bit last year, not a lot, but oil is obviously cyclical, and it's going to help sometimes and it's going to hurt in other times.
So we're reaching the point where I've got a lot of questions, so it feels like we're meandering around, but there's some important stuff to get through, I think. One person's highlighted something quite interesting about what's going on in the current market, and the fact that we're seeing, it feels like we're seeing massive swings, 10% plus swings on nothing more than beating earnings or not beating earnings. And when something like Google moves that much, these are companies we've never seen the size of, and so 10% is a massive swing in terms of market cap. Has there ever been a disconnect like this between winners and losers within the market? Is this a new thing? Because it feels like everything looks like an overreaction, but maybe it's normal and nobody ever noticed before.
No, it's not new. I mean, it's happened, and one of the things that I talked about earlier was the disconnect in valuations between those companies that you're talking about and the average market. So if you have a company like a Google or NVIDIA that may not quite meet expectations, you can see wide movements in their stocks just because their valuations are so high. Whereas others, where their valuations aren't nearly as high, if there's a short-term miss, they may not be as volatile. But this is not new. This is something that we've seen many times, and it's usually driven by technological advances, right? If you get into a period of time where there's something new and exciting that's going on, and the markets are bidding up the prices of whatever company is involved in that, and then as time moves on, there's going to be some companies that are successful and some that are not. Some are going to be unbelievable winners, and some are going out of business. And I thought about it like this: if you go back, probably longer than I should, back to the early 1900s and the advent of radio. I mean, any company that had anything to do with radio in the marketplace saw their stock prices just bid up like crazy. And there are companies that like British Marconi Company, all right, the first radio company, the Radio Company of America, Westinghouse, all companies that saw their share prices just go through the roof during that period of time. They're out of business, right, and survive. Let's go back to the dot-com era from 1995 through 2000. where we saw the tech-heavy NASDAQ up 800% over that period from 95 through 2000. By October of 2002, it had given it all back. And a lot of those companies that saw their share prices bid up to unreasonable levels are out of business right now. Some survived and did very well, most notably Amazon, but there's a lot of others. Pets.com. Does anyone remember Boo.com? They're out of business. And I'm not saying that some of the Magnificent Seven are going out of business, but a lot of what they do, can get eaten up over a period of time. And one of the reasons NVIDIA, I'll just mention this and then stop. One of the reasons the stock price of NVIDIA came down is they started looking at their customers who have been buying these chips to integrate into their cloud-based systems and their AI systems. They've been overspending, for the past year or so. And is that sustainable for them? So they're starting to look at NVIDIA and say, well, maybe selling at 50 times earnings is a little bit too high.
So we've covered technology, we've covered financials, we've covered energy. The next big one is healthcare. Somebody's just asked, how do you see the healthcare market in the future? Is it a coming bull sector?
The healthcare market is a very, very important market. Just if you look at what is happening to the population globally, the graying of America, as we call it, the bubble of baby boomers now reaching their 70s and 80s, where that's where you consume the vast majority of your lifetime healthcare dollar is spent in those years. So just from a standpoint of supply and demand, the healthcare industry is a robust industry. And then if you add on top of that the technological advances that are happening in the healthcare industry right now, with compounds coming to market, with biologics that are coming to market that are proven to be very effective in ailments that one would have thought just 5 years ago would have been very difficult things to combat. So we're invested quite a bit in the healthcare area in companies like Amgen and others that are at the forefront of that technological advancement that we're seeing. And we think that over the next 3, 5, 7, and 10 years that we're going to see benefits to humankind that is coming from biologics that is going to be substantial.
So this last section of these things, I always try and make a bit more quick fire and get through hopefully some of the shorter questions. So again, this probably feels a bit more random towards the end, but I want to get through as many questions as I can. Mm-hmm. So you mentioned at the start the phrase significantly discounted. What metric do you use to define that?
We look at a company and we use the following term, normalization. So if we look at a company that has, say, spent years of capital expenditures building an infrastructure, I don't care what it is, whether they're a manufacturing company or whether they're a service business, you build an infrastructure, and that infrastructure is designed to earn a return. Because we're going to invest our money in, right? Like if you and I are going to go start a business, we're going to get a loan from the bank, we're going to put some of our own money in there, we're going to create an infrastructure, and we expect that infrastructure, when it's operating normally, to return free cash flow to us. So what we want to do, and we do this with every business, is we will completely restate a company's financials based on what are our appraisal of their businesses when they're operating normally. Now, we recognize normal may never happen, but it's a concept that if that business, and you mentioned one example of Adobe. When we first started buying Adobe, we started looking across the valley when they were changing their system from selling software licenses to selling subscription-based model across that, and what it was going to look like when that normalcy happened. And we saw a business that could earn 10 times what they were earning currently. So we're going to value that business based on normal. Now, sometimes normal may be less. I mentioned NVIDIA. We think NVIDIA right now is over-earning, actually. At the time we invested in Adobe, it was under-earning. So we really apply that concept of normalization.
Keeping going, zigzagging through this, I joked with you just before we went live that we haven't had any Bitcoin questions for a while. And while I absolutely have to caveat this by saying this is a US equity only fund, um, a couple of people have asked questions, so it's worth getting, hopefully, as a quick answer. What do you think of all the Bitcoin ETFs launched in the US this year?
You know, it's an interesting topic. It's an interesting concept. We are extremely conservative and cautious when it comes to things like that. You know, we talked about politics and we talked about how regulation can impact businesses. Regulation could certainly impact Bitcoin in an extremely negative way. If the powers that be decide that the opaqueness of that currency market is a challenge to governments everywhere, there could be some issues that arise because of that. So we look at it with interest, but it's not an area that we're going to explore.
Okay, thank you for that. So when you were talking about Microsoft, we had somebody ask, have you recently, or are you adding to your position in Microsoft?
No, in fact, we have actually trimmed it 3 times over the past 10 years. So if we look at, I can't remember exactly what our entry price was. Let me see if I can find that real quickly. We entered at about $45 a share, and it's trading at what, 350 today. So it's been a great investment for us. No, I'm sorry, we started in at $36 a share. So it's been a great investment for us, and we've trimmed it 3 times. And that's a discipline that we have in place just for diversification purposes. If a company becomes such a large position in the portfolio, we want to cut it back. It doesn't mean that we don't have the conviction in the company today that we had in 2014. It's just we want to keep that position size manageable.
Yeah. One sector we haven't touched on. Is Jim concerned at all about the non-performing loans in US commercial real estate? And how does he assess their impact on the banks and wider lending sector?
Yeah, you know, we've looked at all of the banks and stress tested them with commercial real estate because I agree with the questioner there that there are a significant amount of commercial real estate loans that are potentially problematic for a number of banks. Fortunately for us, the ones that we invest in, and I mentioned Cullen Frost. Cullen Frost has virtually no commercial real estate exposure. PNC Financial has a little bit, but if you look at it over a period of time with the loan to value ratios of the buildings that they're invested in, it's probably not going to be an issue. Could there be some charge-offs? Possibly. Commerce has very little commercial real estate exposure. If I was investing in a bank that had large New York commercial real estate exposure, I would be concerned.
And the defense sector has been brought up. And so considering everything that's going on in the world, where do you view things in the defense sector?
Yeah, we actually have quite a bit of exposure in the defense sector. Some of it is direct with a company like General Dynamics that we own relatively broadly. It's not in the North American fund, but we have a number of other businesses that have some exposure into the defense market. We have Oshkosh, which is a company that manufactures vehicles for, think about it as like the 2nd generation Humvees for the US military and the UK military, by the way. They sell into that market. We have Parker Hannifin, we have Honeywell, you know, and both of those companies. Teledyne is another company from the optics standpoint that feeds into defense systems. So we've got quite a bit of defense exposure.
This is an interesting. I'll be interested to see how you answer this one. So, does Jim believe that he can achieve similar returns in the next 10 years as he has in the last 10? Caveat, accepting that he does not have a crystal ball.
No, and you know, if we look at the numbers, okay, so over the last 10 years, we've returned about 12% a year. That's a little higher than normal. So if we look at statistics over long periods of time, it's closer to 10. Post World War II, 10.7, I think, is the compounded number post World War II. So we're a little bit higher over the last 10 years than is normal. If the market achieves 10%, can we get to that almost 12%? I think that's certainly doable. Certainly with companies, and we've kind of increased the dividend yield of the portfolio over the past year or so to earn more of that return through current yield. We think it's doable, but honestly, the last 10 years have been a little bit above normal.
It's good to under-promise and over-deliver. I like that. In the medium term, it feels like a bit of a cliched question, but bear with me. In terms of what keeps you awake at night, when you're looking at the next 3 years, so shorter term, what threats are you really concerned about? When you're going about your work, when you're identifying opportunities and threats, what are the key focuses for you in terms of what can go wrong?
There's so much that can go wrong, and I did actually a talk for partners at SJP a couple of years ago, and the title of my conversation was "It's Always Something." There's always something that is out there to worry about and be concerned about, and the things that worry me most are ones that are not even part of our conversation today. That we don't even know what the next big problem is going to be. We can talk about geopolitical events, and certainly if geopolitical events get worse from where they are today, it can certainly have a negative impact on many businesses. It can certainly have a positive impact on others. But what we don't know right now is the thing that worries us most, right? And so we need to really kind of branch out, and we do this, periodically. We get together as an investment team and we do what we call a secular trends conference. And that secular trends conference is designed to do exactly what you're talking about. Look into the future and see what items that are out there that potentially can be economic disruptors, business disruptors, either globally or regionally, and understand how those things, and just talk about them as an investment team, may impact the businesses that we own. So the short answer to your question is everything. There's always going to be something out there to worry about.
And on the flip side to that, is it a good time to invest right now?
Well, I always answer that question, in terms of what the famous investor John Templeton said to me one time. So I asked him that question because I remember this was in the early '90s, and it was kind of gloom and doom, and the conference was gloom and doom. And I asked him, I said, "Do you think it's a good time to invest now?" And he always said the best time to invest is when you have the money. And I agree with that, because all of these things that we've been talking about here, they're going to come, they're going to go, but the best time to invest is when you have the money.
Jim, time's got ahead of us, I'm afraid. We've had over 70 questions during the course of this, which I think breaks some sort of record. So obviously a lot of interest in this. Thank you so much for your candid answers at such an early time of the day for you. I think it's now about 5:20 in the morning, so you might get an extra nap in. But indeed, thank you to everyone who sent their questions into us ahead of the event and during as well. We'll look through the unanswered questions afterwards and answer what we can and come back to your partners accordingly, if relevant. We'll be looking to do 4 of these throughout the year, as I've mentioned before, with the next one being with Pinebridge on the 18th of July and Johanna Kirkland from Schroders in September as well, both of which will be covering off global equities rather than single country specific funds. Please keep an eye out for those from your SJP partner as well. Before I go, please stay safe, stay well, and we will see you again soon.
Thank you.